Welcome to The Explainer, where we take some incredibly complex market data and turn it into a clear, actionable playbook. Right now, we're diving into the Gold Market Commitments of Traders report for the week ending May 26, 2026. If you've been scratching your head trying to figure out what on earth is happening with gold prices lately, well, you're absolutely in the right place. I'm going to step in as your coach today. We're going to review the tape, and we're going to break down these big, complex market cycles so that even if you're a brand new retail trader, you'll know exactly what the heavy hitters are up to.
So take a seat in the locker room for a second, because we're going to look at the market a little differently today. We're going to look at it like a football field. It's honestly the absolute best way to figure out what the big players are doing. You see, the gold market isn't just a bunch of random numbers bouncing around on a screen. It's a fierce zero-sum game between massive teams with totally opposing strategies. And if you don't know who's on the field, who's pushing forward, and who's pulling back, well, you're just going to get tackled completely out of nowhere.
All right, Section 1. Meet the market players. Before we get into this week's incredibly chaotic plays, let's clearly identify the two massive teams battling it out on the gridiron.
First up, we have the swap dealers. Think of these guys as the giant global banks. In our football analogy, the swap dealers are your immovable, heavyweight defensive linemen. Their entire job? Absorb the hits and hold the line against rising prices. They do this by taking on massive short positions. They're basically betting against the momentum to provide liquidity to the market. When prices start running up, these guys dig their cleats into the turf and try to stop the advance. They are historically the single most powerful defensive force on the field.
On the other side of the ball, we've got the managed money. These are your trend-following hedge funds. If the banks are the defense, managed money is the aggressive, high-flying offense. They are constantly chasing the ball. When the trend is moving up, they furiously try to run up the score by buying. They rely heavily on computer algorithms and momentum to just overwhelm the defense. Understanding this clash between an aggressive offense and a heavyweight defense is absolutely the key to predicting where gold is headed next.
Moving on to Section 2, the unexpected shakeout. Let's review the tape from this past week, because the market just experienced a violently unexpected tackle.
The crucial starting point here is a massive contraction in open interest. We're talking minus 25,836 contracts. Now, in market terms, open interest is just the total number of active contracts out there. But in football terms, it means over 25,000 players were completely injured and had to be carried off the field this week. The game suddenly got a whole lot smaller, and a massive amount of money was just wiped off the board.
To really put that into perspective, this is the single largest one-week decline in open interest we have seen in this entire market cycle. It represents nearly 2.6 million ounces of gold-equivalent positions completely vanishing in a massive deleveraging event. Naturally, when you see a drop this huge, you'd probably expect that the aggressive offense, those momentum-chasing hedge funds, finally broke down and panicked, right? Well, actually, scratch that. That's not what happened at all.
Here is the truly crazy part of this week's report. The aggressive offense didn't panic. From May 19th to May 26th, these hedge funds stubbornly bought the dip. They actually increased their bullish bets on the field, taking their net long position from around 93,500 all the way up to over 97,400 contracts. They covered their shorts and added brand new longs. The fuel for a massive sell-off just didn't ignite. Those trend followers completely defied expectations and kept pushing forward.
Meanwhile, look at what the defense is doing. The giant banks, those swap dealers, actually backed up toward their own end zone. Instead of fighting the hedge funds, the banks covered their shorts and reduced their net short position by over 7,400 contracts for the second consecutive week. Their historic defensive wall is systematically crumbling. The immovable object is actively retreating. This is actually incredibly bullish for the long term, because the defense is giving up ground. But wait a second. If the offense is pushing and the defense is retreating, who exactly took that massive 25,000 contract hit we just talked about?
Which brings us to Section 3, Veterans versus the Rookies. This builds into the single most fascinating contrast of the entire week, how the long-term players reacted under pressure compared to the beginners.
We are really looking at a tale of two entirely different groups here. On one side, we have what's called the other reportables. These are large institutional investors. Think of them as the smart money veterans who have been playing this game for years, taking the hits, knowing the playbook. On the other side, we have the non-reportables. That's the everyday retail traders, or in our analogy, the rookies. And the way these two groups behaved under pressure this week, complete opposites.
The smart money veterans completely panicked and capitulated. They suffered an absolute massacre, liquidating nearly 12,000 long contracts in a single week.
It was the largest long liquidation by any group in the entire cycle. The supposedly stable, veteran core of the market just threw in the towel and ran straight for the locker room. They were the ones who took the brunt of the hit in that massive 25,000 contract shakeout. On the flip side, what did the everyday retail trader rookies do? They outright refused to leave the field. The expected retail flush completely stalled out. The rookies only reduced their net long position by a tiny 290 contracts, holding stubbornly onto over 31,500 long contracts. They're basically out there holding the bag, refusing to capitulate. And honestly, it's a massive cautionary signal for us, because market history clearly tells us the market rarely hits a true bottom until the absolute weakest hands are shaken out.
Section 4, the coach's game plan. All right, halftime is almost over. Let's huddle up, look at the scoreboard, and lay out the exact strategy you need to win the second half.
If we look at our trigger scoreboard, the picture is totally split right now. The banking defense, the swap dealers, are sitting at 166,256 net short. They are incredibly close to our ideal target trigger of 165,000. So that's fantastic progress. But then look at the hedge fund offense, the managed money. We need them below 70,000 to signal a truly safe entry, but they're stuck way up at 97,446. The catastrophically failed to reset, and retail is stalled out well above their 25,000 target. So a clean, synchronized entry signal, it just hasn't materialized yet.
Because that hedge fund offense stubbornly refused to reset, our short-term forecast is kind of split in two. The data tells us there is a 70% chance we see a final, brutal flush of those algorithmic hedge funds in the coming weeks to finally cleanse the market. But you absolutely cannot ignore the 30% risk of a temporary bank short squeeze. With the banks backing up to their end zones so quickly right now, we might actually see a sudden, sharp spike that pushes prices higher first, essentially forcing everyone to buy in right before an even bigger crash.
So what's the winning play for us? Here is your actionable mandate to execute right now. Step 1. Stay safe in cash. The market is incredibly top-heavy and dangerous. Step 2. Absolutely do not short this market. The banks are covering, and a sudden squeeze could literally rip your face off. Step 3. Prepare a staged buying plan. If the banks hit their target next week, you might deploy a tiny, cautious 25% pilot position. But Step 4 is absolutely the most critical. Wait for the final signal before going all in. And what exactly is that final signal? Well, we are waiting for the very last domino to fall. We need to see the hedge funds, the managed money, finally break. We're looking for a weekly drop of 5,000 or more in net long contracts from that specific group. Once we see that aggressive offense finally capitulate and leave the field, a true generational buying opportunity is going to officially open up. And the good news? We are weeks away, not months.
The structural setup for a massive bull run is being built right now by those retreating banks. But that final purge just hasn't happened yet. Keep your discipline, rookie. Stay on the bench just a little bit longer. Don't get caught up in the chop and hold the line. The final flush is coming, but when that whistle finally blows, will you be ready to run onto the field and execute, or will you be left sitting up in the stands,